The question when you're looking at cash and liquid assets ends up being denomination, denomination, denomination. We take this for granted in the US because the dollar is relatively stable. If you go to Brazil or in recent years, Argentina, where the annual inflation rate is 25 to 35%, a few years ago, it was as high as 45% in 1 year. You're basically cutting the value of your savings in half if you leave them in something that would be considered a cash reserve. So the denomination question becomes an issue. And I'm not pretending to be, a currency expert where, okay, if I don't want to be in dollars, should I be in Swiss francs? Should I be in yen? Should I be in euros? What I'm saying is that for 5,000 years, a reliable store of value, savings, and actually what was considered money up until 1971 on a global basis was gold. Right. So it is a reliable reserve. The need for reserves, I think that's where it kind of speaks for itself. We know business cyclicality. Sometimes you need it, and you're glad when you have it. That's one of the things that I think we learned from 2008 and 2009. The global financial crisis did not start out as a liquidation of companies because they were under duress. It started out when Lehman and Bear Stearns looked and they didn't have enough in capital. Like it was a liquidity crisis before it became a solvency crisis. And arguably the weeks leading up to the solvency crisis, they would have said, we have ample liquidity, we're fine. Liquidity disappeared. And that's when things began to snowball in 2008 and 2009. So reliable reserves is an issue. An asset that is outside of the financial system, so essentially you're removing it from counterparty risk. These are the aspects that make gold a solid reserve.